Mutual fund taxation. This is Ken Boyd. You can't have dog urine all over the house. And sometimes we have to deal with unpleasant issues, and now that includes excessive dog urine, at least in my house. And taxes on mutual funds can also be unpleasant, and I'll get to those concepts shortly. My dog Colette is nearly 13 years old and serves as my constant companion while I'm working. And Colette is to the point where she can't fully control her functions, sometimes leaves a trace of urine when she's in one place for a long time, like on couches or chairs or beds. So it's dog diapers to the rescue. A quick search on Amazon reveals dog diaper categories for male and female and for different sizes. And so our diaper transition will begin this weekend. We'll see what happens. Taxes can also be annoying, particularly when there's a tax bill that's a surprise. Preparing for your personal return becomes more complicated each year. If you have an unexpected tax event, the process of planning your tax liability is even more complicated. Your mutual fund investment, for example, may generate more taxable income than you expect. So let's talk about the difference between tax deferred and currently taxable. For starters, you make sure you understand whether your mutual fund is in a tax deferred account or an account that's taxed each year. If you invest through work, you may be using a tax deferred vehicle like a 401k account. Generally speaking, investments that are defined as retirement plans are tax deferred. In addition to your 401k, your IRA account may also be tax deferred. So ask your company or financial advisor to clarify the impact of taxes on your mutual fund investment. Now, there's three areas of tax. The first two are on this slide. If your mutual fund is taxable each year, here are three areas that cause your mutual fund to incur taxes. So consider these warning signs for each type of tax. The first is interest. Interest earned on corporate bonds, agency bonds, and many government securities is taxable. If you own a bond fund that has bonds in it, be aware that interest earned on bonds is taxable to the fund as income. Second, dividends. Dividend earned on common stock is also taxable. Many stock funds focus on buying high dividend stocks like utility stocks as part of the mutual fund's objective. If the goal is to own stocks that pay a higher than average dividend, that will generate higher taxable income and more dividends. So read the summary prospectus for your mutual fund to verify the fund's objective. And finally, realized capital gains. Buying and selling securities generates realized capital gains, which are taxable. These gains can be generated from both selling bonds and stock. That if your fund sells a security at a loss, the losses are used to offset the gains to lower the tax liability by lowering the income. A fund that ramps up its trading activity will generate more gains and losses. So one thing to do is to check your fund's portfolio turnover rate. The turnover rate indicates how frequently the fund trades securities, because if there's more trading, there's more potential for gains and losses. So this is confusing. Unfortunately, there are tools to help you determine the impact of taxes on your mutual fund and its performance. Morningstar is a great site to review mutual fund performance, and one statistic they use is the tax cost ratio, which measures how much a fund's annualized return is reduced by the taxes that have to be paid. So take a look at the tax cost ratio. So to wrap up, use these tips to see warning signs that your taxable mutual fund may create a tax liability, and include that liability in your tax planning. And doing this will help you plan for the next April 15th and give you some peace of mind. And for more great content on accounting and finance, you can go to my Accounting Accidentally Substack page, accountingaccidentallySubstack.com. Thanks.